Stocks and commodities squeeze on a dovish FOMC reaction. Financial conditions ease, but net liquidity is about to fall off a cliff. Vol resets lower, but SKEW stays offered as underweight investors reach for calls. All this and more this week's Macro Insight. Okay, welcome back to Macro Insight, everyone. Today is the 2nd of August. Let's have a look at these markets. Okay, so last week, what was going on? Obviously, we had a bit of a squeeze in the market, right? Big events last week. Main events were FOMC and the mega cap tech earnings. So bring up our usual graphic here. We can see from a vol adjusted basis, what were our major movers? Obviously, you know, you look at these tech stocks, Microsoft, Amazon, Alphabet, etc., all looking at 1.5 to 2 sigma moves to the upside. You know, all of them pretty much beating earnings, guidance not as bad as expected, things like that. I mean, Meta was the only one that was down. Outside of that, you know, you had Amazon up about 10%, Google up about 7%. Pretty stellar earnings, really, from that bunch of names that, you know, continue to keep roaring higher. Now, obviously, the 75 bip hike was well flagged and well priced in, but the market still ripped higher on comments from Powell. So the main comments really being that we're at neutral rates, dropping forward guidance, and now being data dependent. And the market decided to take that very dovishly. We obviously can see all the blue bars here on the right-hand side, where rates basically came lower. So the dovish reaction. And you also had that in the front end as well, right? So, you know, the 2-year moving as well. Commodities, pretty large vol adjusted moves. You can see here soy, silver, copper, and iron ore, all having, again, 1.5 plus sigma moves to the upside. Obviously, nat gas a bit calmer, and oil smalls down on the week. In FX land, the dollar retreating, particularly against the yen, which is catching a bit of a bid on short covering, and in line with kind of the rates move and what's driving things in the yen there, those rate differentials. But, you know, we are on critical levels now on the yen, actually breaking below 131.5 overnight is quite a big move. It's quite a big level, basically, so that could open up some room to some serious downside still in dollar yen. Euro and GBP obviously bouncing from pretty beaten up levels. We had obviously touched parity a few weeks back, but Euro kind of settling in there around the 102.5 level, not really doing a whole lot. And then cable also having a bit of a bout, cable being GBP for those of you who don't use that terminology. GBP dollar rallying ahead of Bank of England this week, which is expected to go 50 bips basically. And then in the rates curve, we did see the 2s10 invert even more. Not on the original FOMC meeting, but since then it's gone through 30 bips inverted. And, you know, Treasury is just generally catching a bit of a bid on poor macro data, with the front being relatively anchored. So we continue to see that inversion in the yield curve. And then lastly, crypto markets remaining positive, losing some of that momentum after the weekend, but moving in line with equities pretty much. So that correlation kind of recoupling again. You know, we'd seen a couple of weeks of them doing their own thing a little bit. That seems to be following stocks again now, basically. Okay, so that's your main sort of market action. If we then have a look at what we're seeing, inflation. So obviously PCE came out. So you can see real PCE. So this is just some slides from what Darius put on his macro minute last week, but just saying that the consumer's tapping out. So you're seeing real personal consumption expenditures, very little growth there. You're seeing prices accelerating. So we look at median CPI, sticky CPI, core PCE, you know, all of that kind of going in the wrong direction. And considering what the market reaction is to the Fed, the fact that we're still seeing inflation data pointing in that direction, the very dovish reaction and the market pricing in a pivot may be a little bit premature, basically, right? And that kind of, you know, also lines up with what the likes of Mike Hartnett are saying from Bank of America. He's been a very loud bear all year. actually did step in and call a bit of a tactical bullish view before the market rallied. So he's been timing the market pretty well, even though he's been fundamentally bearish all year. And he's basically also saying that doesn't really see a policy reversal unless we get a recession, right? And we need a more, looking back at kind of the 70s and what was needed to have that pivot and that reversal, we're still a ways from that, basically, right? So for the market to just suddenly price in a pivot and for the Fed to actually pivot without us seeing any of the pain looks pretty unlikely, looking at past analog, right? That's what they're saying. Also, Mike Wilson of Morgan Stanley kind of echoing the same thing, right? So all these strategists who've kind of been calling this pretty well and have seen this coming, are all thinking this looks a bit premature in terms of what the market's pricing, like everything's rosy, the Fed's pivoting, it's all done, basically, right? That doesn't seem to be, it doesn't seem to me and to these guys that path, that easy path is the most likely path, basically, right? We may well still see a bit stickier inflation for some time. Looking at the chart on the bottom left, even if we got CPI between 0 and 0.6 month on month for the rest of the year, then by the end of the year, these are the potential outcomes for CPI: 6.3 to the low side, 10.2 to the top side. Are these numbers enough to justify the Fed pivoting? Not so sure, right? They still look quite elevated, basically. Okay, they're calling neutral. We'll talk a bit more about neutral rates actually in a bit in a later slide. And then the last thing Hartnett points out is that maybe the housing market needs to crash to actually create the pivot, basically, right? So we were all thinking earnings was going to be the next shoe to drop. That was what was going to trigger the bearishness. This was going to ultimately force the pivot and the kind of negative wealth effect. Well, maybe it's the crack in the housing market that needs to turn into a steep deterioration in that market. I mean, rents are still very, very well bid. So in the face of what rents are doing, I don't know how much the housing market absolutely collapses, because unless you're forced to sell, you can just rent property out and get really healthy rents from it, basically, and healthy yields from it. So I don't know how that plays out, but obviously a lot of leading indicators, mortgage applications, housing starts, new home sales, all these things are rolling over quite dramatically. So maybe that's the start of something, right? So it's definitely something to keep our eye on as maybe the next bearish catalyst, maybe. Jobs data out this Friday. Expect that to be noisy, as it always is. But looking at what claims are doing, and they often sort of lead payrolls, there is potential there for some disappointment. If not this month, in coming months, maybe it takes a bit more time still. But we've seen the bad data equals good news dynamic playing out regarding the rates hike path for 2023. Does that flip this week? Do we get a strong non-farm payrolls and more hawkish Fed speak, and then we see good news as bad news, right? There is the potential for that if non-farms basically come out okay, right? Cash carries already, supposedly a big dove, already talking more hawkishly over the weekend, basically, right? So it might be that the Fed sees the market reaction to what they were saying about data dependency, and the market's just taking it a bit too far, and maybe they walk it back a bit, basically, right? So wouldn't be surprised to see a bit of Fed speak this week, try to walk that dovishness back a little bit, given what's going on. I mean, we look at and if we look at the next slide, financial conditions, right? They're trying to tighten financial conditions. That's how they get on top of inflation. If what they say is met with a massive risk on melt up, that's kind of counterproductive to what they're trying to achieve, basically, right? So we can see here, change in US financial conditions year to date. This is basically converting it to like a Fed funds equivalent in terms of basis points. And we've seen, from the most tight financial conditions we saw in June, we've eased about 100 basis points, basically, right? That's what we're saying. The 3-day change in financial conditions around FOMC meetings, so we can see what actually goes on around the meetings. We had obviously a tightening a couple of meetings ago of 25 bips, but the last two meetings have been met with quite large easings in financial conditions of 22 and 40 bips, basically, which again is probably not what they want to do in the face of these inflation numbers and this sticky inflation that we're seeing. Okay, last chart I've put on the right is this net liquidity model that is used by the likes of Darius. It's also used by this person, Max Anderson, on Twitter. And what does this show us? It basically tries to kind of superimpose the net liquidity, which is the Federal Reserve balance sheet minus the TGA account and the reverse repo facility as a gauge for the liquidity out there in the system. And it tracks pretty well with what the S&P does. Obviously, there's a fair amount of volatility in the S&P around that line. But if we look at the green line, and if I zoom in a bit on it, we see the S&P's ticked up quite aggressively relative to where the green border is. And that is headed much lower over coming months, right? As we head towards the end of the year, I mean, that's got a lot of room to come in, right? Because that's factoring in what we're going to see with regards to QT. The pace of QT is going to double in September, right? And so that is likely to be a bit of a gravitational force pulling the S&P down over coming months, right? So whilst, I think Max Anderson on Twitter was basically saying they were looking for a 2-3 week sell-off for this thing to come in line. I wouldn't be as confident to make the call that it's going to manage it in 2 or 3 weeks. It might do, who knows? But you'd be more confident that by October, where this green line is like a significant amount lower, that we are going to be being pulled back down by that, basically, right? So those are the odds. The odds are the S&P is going to start to find a bit of resistance, right? So certainly that's one force pulling the S&P down. Now we know the systematics are still net buyers in the face of low realized vol, but that's the to and fro, that's the tug of war that's going on right now, basically, right? And a lot of the strategists who were calling for a bear market bounce are now looking at levels to reinitiate shorts. And so you would have thought a fair amount of the kind of investment community who has covered shorts on like the 3,800 area is probably happy to redeploy them at 4,200, basically, right? So that probably does provide a bit of a cap on the market and a bit of resistance, basically. Okay. What's been going on there? What's been happening in the options landscape? We did see a shift higher in the call wall, spot gamma's call wall, so that they're seeing here they've kind of shifted that up to 4,200. As we kind of broke through that 4,000 area and everything kind of shifts up. Now, in theory, though, the call wall idea is kind of predicated on the 4,200 area being where dealers are long stuff, right? Where they're basically getting long strikes. And I think that's kind of, contradicted by the fact that we have seen a pickup in index call buying. So we've also got this kind of, options flow showing that we've got call buying coming in as the market's ripping higher, okay? Now that is also confirmed by the idea here where we've got SKEW, and this is from my Vol dashboard, I've just chucked in as reference the S&P 25 Delta SKEW in the 1 month and the 3 month. And we can see SKEW is still pretty much at the bottom of the range, right? So that kind of does jive with the idea that call buyers have come in on this rally, not put buyers, if anything, put sellers. That's kept SKEW relatively on the low end, okay? So we've seen the term structure collapse over the course of, that was fairly flat term structure last week is now collapsed into contango, which is normal. It's what you would expect to see post like an FOMC event, right? But the fact that SKEW has stayed down at that bottom end of the range does kind of suggest that call buying is going on. People who are underweight are using calls to protect it. So then I'm not so sure if that means then that the street has to be getting, pinned around that 4,200 area, right? So again, there's that whole inconsistency with the flow we're seeing versus, whether the street is long or short in a certain pocket, right? Obviously, we've seen vols come down, right? So that might suggest that there's been a net selling of vol, but it's also the event risk coming out. But if we're seeing call demand on this rally, then, I'm not sure how relevant the 4,200 strike is going to be to actually pin the market. I would need to see another week or two of low realized vol in the vicinity of that 42 strike to confirm to me that the street is actually quite long that area, right? Because the basic gamma models are all saying street's long again, expect vol to do nothing. I think we need to actually, before just making that blanket assumption, I think we need to see the realized fall off a bit of a cliff now that we've repriced up here. And that will then confirm to us that, yes, the street is quite long, that gamma around there. And we can believe that. But right now, what I'm seeing in the call in the call buying, what I'm seeing in the SKEW doesn't necessarily line up with that idea. Okay. Jim Bianco put this chart out. He actually brought it up on his Real Vision interview last Friday. If you haven't watched it, I suggest you do. Jim's always worth a watch. But basically looking at inflation forecasts and just saying how bloody wrong they've been, right, for a long time. Yeah, he's gone back to 2018, right? So to basically saying inflation's always expected to mean revert back to the 2% target, okay? And yet what actual inflation has done has been a straight line higher, okay? So he's saying instead of this stupidity of just like pinning yourself to that 2% target and saying long run inflation is always going to be 2%, therefore neutral rate has to be 50 bips above that, is basically what he's saying, how they've arrived at that fact that they're at neutral rates. Why don't they look at what's actually happened in the market since COVID, how the economy has structurally changed and how inflation dynamics have structurally changed, and look at it that way. So the chart on the top right is looking at durable goods, non-durable goods and services, right? And saying that since COVID, right, the makeup of what we spend money on has changed, right? So, you know, the durable goods expenditures are so much higher than services, okay? And because we work from home a lot, so we need to buy stuff to have at home. We're not necessarily going to go out for the coffee that we were going to go out for with our workmates or go out for drinks after work and stuff like that if we're working from home, right? So that change in the way people work is made a structural change in the demand for goods and versus services. And that has made a structural change in long run inflation, right? That's what Jim's arguing. And I can sympathize with that view, right? So you can see here in the bottom chart, you know, rates have popped to 2.5. That's what the Fed is calling. The Fed's neutral rate has been dropping, you know, steadily for the last 10 years. Okay. Now, every time the Fed becomes restrictive, they break something. So the idea here being that first, they haven't gone restrictive yet. Now they're due to go restrictive if they hike 50 bips in September. So they'll be supposedly 50 bips above neutral. Okay. And just looking back at when they do go into restrictive, they typically tend to break stuff. Okay, so we haven't gone into restrictive yet, apparently. Again, we don't really know what the true neutral rate is until after the fact. But assuming if the Fed's right, which I suspect they're not, but if they're right and neutral's here, then we're gonna go into restrictive in September. If the neutral rate's higher, then arguably we're not going to go restrictive until we've done a few more hikes and then really make a dent in inflation, right? To make a dent in inflation, you know, Alf argues that you have to go restrictive, right? You can't just go to neutral and expect inflation to magically sort itself out, right? Unless we go into some massive recession, and then yes, it will sort itself out. But then that doesn't seem to be being priced, right? A soft landing seems to be more what's being priced, yeah, by risk assets. Okay. Anyway, so that's what Alf and Jim have been talking about, right? You know, and silver having a decent rally. Always worth keeping an eye on what real yields of the dollar are doing to get a handle on these things. We had a pretty decent repricing in real yields from, you know, around 45 basis points positive back to 0. So that's a significant move. So that kind of helped give a tailwind to gold. Gold obviously got whacked down to that 680 level, but held it the previous week. Since then, it was hanging out at around 1720, and it's now back at 1780 nearly. So it's had a decent uplift from that move in real yields, and also, you know, the dollar moving back towards 105 in DXY has helped as well. Okay, silver massively outperforming by about 7% on the rally, outperforming gold. I had mentioned the gold silver ratio had got to quite juicy levels, hence why I added a bit of silver to the long-term portfolio a few weeks back when we hit those sort of low 18 area. That worked out better than I could have imagined. That worked out pretty quickly. It's not a tactical trade, that one. That was just me accumulating a bit of silver for the long-term book because I hadn't had any for ages, and it had reached quite nice entry points. So, you know, yeah, it's made a bit of cash. Wouldn't be surprised if it goes back to that level, but I'm not going to do anything with it because it's a longer-term allocation that I'm averaging into over time, basically. Thanks for watching, guys. If you like this content, please subscribe to our channel. Give the video a thumbs up and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.